Hey there! Okay, quick question. What do the US, Japan, France, Brazil, and pretty much every country on Earth have in common? No, it's not soccer. Nope, not their love for weird snacks. They're all wildly in debt. Seriously. Some of them owe so much money, it makes your student loans look like spare change under the couch cushions. Take Japan, for example. They owe more than twice the size of their entire economy. That's like making $50,000 a year, but owing $100,000 on 10 credit cards, a lawnmower, and maybe your neighbor Steve. But wait, how can that be? If countries control their own money, can't they just, not be in debt? Let's break it down. Imagine a guy named Dave. Dave is a nice dude. He runs a small town, let's call it Daveville. Dave needs to pay teachers, build roads, fund hospitals, normal government stuff. But Dave doesn't have enough tax money coming in to cover all of it. So what does he do? Borrows money. Maybe from the townspeople, maybe from the bank. Maybe he prints Dave bonds and promises, I'll pay you back later with a little interest. Now multiply Dave by 195 and you've got Earth. Like, is there some secret money wizard living in a volcano just handing out cash? Every country borrows money. Just like Dave, they issue government bonds, basically IOUs and people. Banks in other countries buy those IOUs because they trust they'll get paid back. Eventually. We are going to get sidetracked for a bit. You're probably wondering what an IOU is. It's basically short for IOU. It's a simple promise to pay back a certain amount of money or provide a service in the future. Often used for small, informal debts. All right, now let's get back on topic. You might be thinking, okay, but if everyone is borrowing money, who are they borrowing from? It's a mix of regular people, banks, investment funds, other countries, and weirdly sometimes the country itself. We'll get to that. Let's go back to Dave for a second. Say you live in Daveville. You want to save some money for retirement? So you buy a Dave bond. Dave uses your money to fix the roads. In a few years, he pays you back with interest. You've got a safe place to park your savings. Dave got a new pothole-free Main Street. Everybody wins. It's kind of how US government debt works. About 2/3 of US debt is actually owed to Americans. Pension funds, insurance companies, banks, and even regular folks like Grandma who doesn't trust the stock market but loves her treasury bonds. So when you hear the US is $34 trillion in debt, it's not like the country is about to get evicted. A lot of that debt is just Americans lending to themselves through the government. Now, the other part. That's where things get more global. Countries lend to other countries all the time, like China holding US debt, or the US holding UK debt, which Dave also controls. It's like one big, slightly awkward international group project where everyone owes everyone something. Here's where it gets even weirder. Some countries owe money to their own central bank. Imagine Dave borrows money from the Bank of Daveville. He literally owes himself. That sounds sketchy, but it's common. It's called monetizing the debt, and it usually involves the central bank buying government bonds to keep the economy stable. But let's not go too deep into the monetary policy swamp yet. Stick with our buddy Dave. Over time, Dave keeps borrowing more. Why? Well, because it's easy. People keep lending him money. Interest rates are low. Because for most lenders, buying government bonds is one of the safest bets out there. If he needs to, he can just roll over old debt with new debt, like refinancing a loan forever. Sounds dangerous? It kind of is. But weirdly, as long as people trust Dave, they'll keep lending, even if it means lending to someone who's already $34 trillion in the hole. Now, if this sounds like a financial version of musical chairs, where nobody wants to be left holding the bagger, not wrong. Because what really matters isn't how much debt a country has. It's whether people believe that country can pay it back. It's all built on confidence. Maybe Janet Yellen holding a giant pillow of cash. You lose that, and suddenly, those bonds look a lot less cozy and a lot more like flaming IOUs. And that's when countries get in trouble. Like real trouble. Argentina-style trouble. But we'll get there in a bit. And when they do, it's not like a late credit card fee. It's more like setting off an international money panic. For now, think of national debt less like a credit card and more like a really complicated trust exercise. But instead of falling backwards into your friend's arms, you're falling into the arms of global markets, banks, hedge funds. That's not even an exaggeration. At this point, it's practically a national tradition. So where exactly does all this money come from? And what happens if a country just says, nah, I'm not paying it back? Well, Let's talk about what happens when a country doesn't pay it back. You'll get your money eventually. Maybe, probably not. Because yeah, that's a thing. Countries can default on their debt. They're stuck with rising prices, lost jobs, and shrinking paychecks. Take Argentina, for example. They've defaulted 9 times. 9. When a country defaults, it basically tells lenders, sorry, we're broke. And that's when the real chaos starts. Investors freak out. Currencies crash. International lenders back away, like someone just dropped a fart in a crowded elevator. And the people living in that country, remember our guy Dave from Daveville? Imagine if Dave stopped paying his bondholders. Suddenly, the people who lent him money, local retirees, banks, maybe even Dave's Aunt Marge, can't get it back. You lose that. And even printing your own money won't save you. Now trust in Dave goes poof. And no one wants to lend to him again. That's basically what happens to a country when it defaults. It's not just the money. It's the trust that breaks. And trust is everything in global finance. Speaking of which, let's talk about that little fantasy for a second. Why don't countries just print more money to pay off their debt? Ah yes, the classic move. In that case, the debt's not crushing, it's manageable. Feels like a cheat code, right? But it's more like giving your economy a sugar high and then watching it faceplant into hyperinflation. Printing more money doesn't actually create more value, it just makes each dollar worth less. It's like slicing the same pizza into more pieces. Everyone's still hungry, but now your slice is just sad and floppy. And if a country tries to pay off debt this way, investors will notice. Oh hey, you're printing your way out of this. That's exactly what happened in Zimbabwe and Venezuela, where you needed wheelbarrows of money to buy bread. So yeah, not a great fix. Okay, but here's another wrinkle. What if the economy grows? Over 200% debt to GDP. See, debt isn't automatically bad if your economy is also growing. It's like borrowing $100,000 for school, but you land a job that pays $200,000 a year. Same thing with countries. If the economy grows faster than the debt does, everything's chill. Lenders stay happy. Governments pay bills. But they're super charming, and you just know they'll win the lottery one day. Nobody panics. That's why you'll sometimes hear people say, debt to GDP ratio. It's just comparing how much a country owes to how much it earns. Like your income to debt ratio, but with way more suits and way fewer ramen noodles. Now here's where it gets kind of hilarious. Some of the richest countries in the world are also the most in debt. Japan, the US, over 100%. With not digging themselves into a hole so deep they can't see daylight. The UK, France, Italy, same club, normal, but nobody's panicking. Why? Because these countries have strong economies, stable governments, and most importantly, reliable central banks that don't wake up one day and decide to throw the currency out a window. It all comes back to that magical word, confidence. As long as people believe in your ability to pay, they'll keep lending you money even if you're already swimming in it. It's kind of like when your friend always borrows $5 and never pays you back. Except here the charm is the economy. Now here's one last twist before we wrap this up. Not all debt is bad. In fact, debt can be good. Just ask them. Yeah, but compared to what? Do people still trust us? It can fund education, build infrastructure, launch new tech things that help the economy grow long term. The problem isn't debt itself. It's when debt gets so big that the interest payments start eating up everything else. Like paying so much on your credit card bill that you can't afford dinner. Governments have to balance borrowing for smart growth, with not digging themselves into a hole so deep they can't see daylight. So yes, every country is in debt. And weirdly, that's kind of normal. As long as the debt is used wisely and people trust the system, it keeps spinning. But the moment that trust starts to wobble, well, that's when the money train gets bumpy. So in conclusion, countries borrow money for the same reason most of us do, to pay for stuff they can't afford up front. They issue bonds, promise to pay them back with interest, and hope everyone keeps believing in their ability to do that. Most of the time, that works just fine. But when confidence cracks, debt becomes a very expensive problem very fast. So next time someone yells, "Our national debt is out of control," if the answer's yes, we're probably okay. If not, well, maybe ask Dave what he's been up to lately. If you want me to make other videos explaining these topics, please like and subscribe to Econ Made Easy. Thanks for watching.